morning and happy Sunday from Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, October 20th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about the latest financial market conditions. Specifically, should we still be on offense and looking for new opportunities, even though the market is up about 40% since this time a year ago? Or should we now be playing defense and protecting our capital and some of our gains over the past year? This is Asbury Research's 20th year in business. What makes us different from other research and asset management firms is that we are completely data-driven, not trying to predict what the Fed might do or who's going to win the election and what all of that may mean for future stock market prices, or try to forecast where the S&P 500 is going to be at the end of the year. We think a lot of this is a lot more show business than it is the fact is that nobody knows any of this stuff ahead of time, and nobody especially doesn't know how any of these events, should they occur, how they're going to affect the direction of markets. So at Asbury Research, just follow the money, because the money never lies. The movement of money is what really drives asset prices and is the most sensitive and accurate indication of the subtle changes in market opinion that ultimately change the market's direction. Asbury Research is a registered investment advisor. We're an RIA, and we've been providing both investment research and asset management to individual and professional investors since 2005. Get more information about us, visit asburyresearch.com. That's where I am right now. And click the Contact tab. You get to the Contact tab by hovering your mouse over About, scrolling down to Contact, clicking that. Or you could just click the link underneath in the description of this video. Finally, if these videos are useful to you, please like and subscribe. Let's begin with just a few quick announcements. Number one, we now have a Substack newsletter. If you like our Following the Money podcasts, you can get more of us, more of the same kind of information via a free Substack version that you could sign up for at asburyresearch.substack.com. I'm showing you that right here. We've got videos here. We have a subscription version of this, and we also have a free version. So if you like the way we look at markets, this is another way to see a little bit more of us. Next, we have recently, let's take this next. Next Wednesday, I'm going to be interviewed on Wednesday afternoon. That's October the 23rd on Investors Business Daily. I do about 2 to 3 of these a year for IBD. I like these because the interview is long. It's almost an hour. And I get a chance to really get in depth in terms of what we're thinking here at Asbury Research. We go through all of our models, our latest ideas, and we can really give a pretty comprehensive overview of how we're looking at markets. Next, we have recently taken a lot of our own models and combined them in different increments to create 4 model portfolios. We are actually going to take a closer look at one of these today, the Asbury Ultra Conservative Portfolio. We have 4. You can get more information on these models, including a prospectus on each of them by visiting asburyresearch.com and then clicking Asset Management. That's right here. So we'll go to Asset Management, and you can see all 4 of our model portfolios are here, and you could download the prospectus on each one of those via these little buttons at the bottom of each of these individual boxes. These models can be implemented yourself with a subscription to our premium research, or we can now trade these portfolios for you within your own investment portfolio or your client's portfolio. We could do this either through money management, or again, we show you how to actually implement these into your own portfolio if you're a subscriber to the premium research. Now let's follow the money by identifying our key areas of focus as we look towards the upcoming election, which is now just a couple of weeks away. Number one, tactical market direction. We're going to move back here. We're going to click on the Research Center. This is the password protected part of the website, and we're going to go down to the Asbury 6. The Asbury 6 shifted back to positive status on September the 12th and has risen by 5% since then. The Asbury 6 is our daily updated risk management model that looks beyond the day-to-day volatility and noise of the stock market to determine its actual health. We do this on a daily basis. The Asbury 6 is updated at the end of every business day, typically about 2 hours after the close. We view the Asbury 6 as a lie detector test for the market that helps investors to identify real sustainable market advances or declines from computer-driven traps for investors. We've all seen those traps. The market opens 50 lower, we're scared out of our position, and by lunchtime it's 50 higher. This helps us to keep our focus on the internals of the market and not get caught chasing the tail of the S&P 500, as I like to call it. So of the 6 Asbury 6 metrics, we have the rate of change, we have the relative performance between stocks and high yield bonds, we have investor asset flows, we have volatility, we have trading volume, and we have market breadth. 5 of the 6 are positive. 4 or more of these in one direction, either green for positive or red for negative, are necessary to have a directional signal in the model. So again, since September the 12th, we have been 4 or more green. We are positive headed into next week. Now let's move to sector rotation via our CEF model. Our CEF model, as we get back here to the Research Center, go back here, asburyresearch.com. The CEF model was created about 7 or 8 years ago to quantitatively identify long/overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector spiders, which if you put them together, it's the S&P 500. The CEF model is always fully invested in the market, which provides investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. Rather than just being in the S&P 500 for 40% of your portfolio, you're actually investing in the 3 sectors that have the best asset flows that are coming into them. The model's updated weekly, on the weekend, and the new signals are implemented on the opening the following Monday morning. You can learn more about all of our models, including charts and back-tested performance tables, by visiting asburyresearch.com and going to the Models tab, which is right here on your screen. And this is what I want to show you today, is part of the CEF model for us are the accompanying charts, and we call them rainbow charts for obvious reasons. And we're going to look at 2 of our top 3 ranked sectors heading into next week by the rainbow charts. Rainbow charts for obvious reasons. Up top here is the daily CEF signal, whether it's favored, which is green, or neutral, which is yellow, or avoid, which is red. It shows you over the past year where that signal has been. And the takeaway here is when a given sector, this is financials, this is XLF, stays in favored ranking for a sustained period of time, as we did here from like November of last year through late February of this year, we typically get relative outperformance by that sector versus the S&P. So down here is the relative performance of XLF versus SPY. SPY, of course, is the one that tracks the S&P 500. So what we're showing here now, over the past couple of weeks or so, the status of the CEF signal for XLF has moved back up into favored territory. And you can see we've had a lot of nice relative outperformance by XLF versus SPY just over the past couple of weeks. If you follow the markets closely, you've seen this. You can see the last time that we were up here in favored status, let's call this middle to latter part of June through middle to latter part of August. All of this in here where we stayed up in favored status Look at the relative outperformance we caught here. So we're starting that again. We can't see the future, but right now, according to the CEF model, there's a lot of positive asset flow going into XLF in multiple time periods. This is how we determine where to allocate money within the sector space. The next one we're going to look at is one that's been favored status for much of this year. It's been a really positive performer this year, and that is utilities XLU. So what we're seeing is since, let's call it second week of July, first or second week of July, through a couple of weeks ago, we had a sustained period where XLU got into favored status and stayed there. That gave us all of this relative outperformance here by XLU versus SPY. We dropped back into neutral territory just for a short period, and now we're back up into favored. We don't know how long it's going to stay in favored territory. It hasn't happened yet. Nobody knows that, but for right now, we're getting a surge of assets that are moving back into utilities, and because of that, that is one of our top two. Of the top three, XLF and XLU are a part of that top three. The next thing we're going to look at is we're going to look at a few charts and data series that we believe are going to be particularly influential to market direction next week. These charts and analysis come from this past Thursday's Keys to This Week report, which is a part of our premium research service. You can contact us directly for pricing on this service by going to the contact tab. So what we're going to do here is we're going to move back to the website, and we're going to go into the research center. And then we're going to scroll down to our Keys to This Week report. Here's where all of our models are on the research center. I'm going to scroll down a couple here and go down to Keys to This Week, which went out on Thursday, this previous Thursday. And the ones that I want to look at here, Keys to This Week are the 10 charts or models or data series that we think, after looking at over 100 of these things, what are the most important ones to pay attention to for the upcoming several weeks to come. And as the market changes, we look at different things. But right now, the ones that we're really interested in, a couple of these we talked about the last time I was with you on August the 6th, which was 2 weeks ago. One of them was, we talked about a chart pattern in the NASDAQ Composite Index, which we're looking at now daily since 2024. 200-day moving average is here in orange. It's a major trend proxy. So what we talked about was on September 19th, we had a breakout from this period of investor indecision, this sideways movement since July the 11th. So we had a breakout on September 19th. We set a targeted to move to 20,250. So now here we are 2 weeks later. Comp is up by 4% since then, and we're testing that previous high on July the 11th, which is 18,671. If we get through there, it's going to clear the way for further gains. So the comp tends to lead the S&P 500. So we're really interested in seeing what happens to this chart over the next couple of weeks. The second one, we also talked about this one when I was with you on October the 6th, is NVIDIA. NVIDIA is the second largest stock according to market cap. And as you would imagine, it's got a very tight linear correlation to both of the NASDAQ indexes. So NVIDIA broke out of a similar sideways investor indecision pattern. You could see the 200-day moving average underneath here, which is kind of like a moving trend line to us. So we broke out of this pattern on October the 7th, which indicated that this larger uptrend, which originated back in early 2023, was re-engaging. That targets an eventual move up to 169. Since I was with you last, NVIDIA has risen by 13%. So just between the two following the monies, we've got a 13% move higher here, and you could see we're testing the June 20th high at 140.76. We get through there, it's going to clear the deck for more strength. Finally, let's take a look at our ETF trade ideas. So we're going to go back to the website. And we're going to go to our ETF trade ideas. This is part of the premium service. And we're going to look at a few of our ideas, our trade ideas. So our trade ideas for ETFs are based on 4 criteria. 1, it has to have a positive price trend. Number 2, it needs to have relative outperformance versus the S&P 500. The way we look at markets here is if it's not outperforming the S&P 500, then why not just be in the S&P 500? It's 500 stocks. It's a little less jumpy than buying an individual ETF and certainly buying an individual stock. Number 3, I want to see expanding investor assets in these. I want to see the AUM expanding in these ETFs. And then 4 is the only one of these that is subjective based on my 40 years of experience. We look for those ideas that already meet the top 3 criteria, and we look for the ones that have the best risk to reward ratio. What does that mean? It means we're never buying underneath a resistance level. We're always buying after we break out from a resistance level. We're making sure the risk reward on these things are solid. So the 4 that we're going to look at are GLD, and you can see GLD down here. We've been in GLD since August the 19th. Since then, it's risen by 9% outright, and it's outperformed the S&P 500 by 4%. We're going to look at XTL, which is right next to it here, Telecom. It's one of our older ones. These are all in order of when we gave the idea out. So on 8/20, August the 20th, we put out an idea, and this goes out for our premium users with an email, a branded email that we call an Asbury Alert. You can see since 8/20, that has risen by 10%, outperforming the S&P by 6%. And then the last one we want to look at is KCE. That's one of our newer ones. That's Capital Markets ETF. We put that idea out on 10/2. Since then, it's up 9% outright. It's outperformed the S&P by 6%. How does this all work? Over the past 18 months, from March of last year through the end of September of this year, we have put out 72 trades here. Percent of winning trades is 60%. And the average winning trade is right here. Average winning trade up 4.5%. Average losing trade is down 2.2%. So we're twice. Our winners are twice as big as our losers, and we're winning most of the time. That's the winning combination for either picking stocks or picking ETFs, picking any group of individual assets over time. You want to have more winners than losers, and you want your winners to be bigger than your losers. These are trades for those that like the shorter term trades. Now, some people buy these and use these entries as a longer term entry for an ETF that they've been looking to get into because we identify very good places to buy them. But our average winning trade length is about 16 business days, or a little over 3 weeks. And our average losing trade in days is about 8 business days. So our winners, twice as big as our losers. Most of our trades are winners, and the time that we're in the winning trades, which is logical, are going to be larger than the time that we spend in our losing trades. So we're going to look at each of these individually by moving over to, so let's look at gold first. Gold, here's where we put that trade on. Here's where we put the idea out to our subscribers on 8/19, and you can see it was just starting to break out from this long kind of rectangular pattern. Here we are here. So taking that up to the top, we're up 8 or 9%. Down here, this is the relative performance of GLD versus SPY. And you can see that we've got outperformance here, and we're outperforming on a 63-day basis. That's what the gold line is here. So as long as gold continues to conform to the criteria, we're going to stay long gold. That could be next week, and it could be next year. We follow these trades until the conditions change. The next one that we talked about was XTL. Here's XTL. You can see we put this trade on. Actually put this trade on twice. We put it on here on June 4th, and we got out of the trade right here on August 2nd for 10% gain and lots of relative outperformance between here and here. So we re-put the trade on again here. This is when we're talking about now the trade that's live, so to speak. 820, we bought it here. Now it's testing this long-term resistance level that goes all the way back here to 629. So we've got this trade on a short leash. If this starts to retract from this resistance, we're going to ring the cash register on the trade and take our money and look for a new idea. If we get on the other side of this resistance, however, which is about 104, we've got blue sky for much bigger gains. So that's our second one we talked about. And finally, KCE is a relatively new trade. So we bought that trade right here, or put the idea out to clients, to subscribers right here on October 2nd. You can see it was a pretty good, it's a pretty good entry. Our initial target was 135. That's what this line is. So it just exceeded that. We're going to stay with the trade again as long as the criteria are all good. And look at this nice relative outperformance we've had. So that's what we've got for you today. Get back here to asburyresearch.com. That wraps it up for today. Our next Following the Money podcast is going to be 2 weeks from now on Sunday, November the 3rd. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience in the financial markets and almost 20 years on the floor of Chicago Mercantile Exchange in the 80s and 90s, and our own data-driven models. You can request more information, again, by going to asburyresearch.com, hovering over About, and clicking the Contact tab. Hope to see you again here soon, and please don't forget to like and subscribe. Have a great Sunday.